What happens when a former US president takes an extraordinary geopolitical action against one of the world's most oil-rich nations, and the stock market barely reacts? That's exactly what we saw after Donald Trump's Venezuela move, which many expected to shake global markets, oil prices, and US equities. Yet, the S&P 500 stayed resilient, oil barely spiked. And risk assets didn't panic. So today, we're breaking down why markets shrugged it off, why investors still see a bull case, which stocks were actually affected, and what this tells us about market psychology in 2026. Let's get into it. What was the Venezuela action? Trump's move, whether framed as renewed sanctions pressure, enforcement actions, or political escalation, was seen as aggressive by historical standards. Venezuela matters because it holds the world's largest proven oil reserves. It's a key supplier of heavy crude, especially relevant for US Gulf Coast refiners. Any disruption should theoretically push oil prices higher. So naturally, investors asked, is this an oil shock in the making? The market's answer: not really. Why the market didn't panic? Let's break down the three main reasons. Key Cap 1. Venezuela is already priced out. From a data perspective, Venezuelan oil production today is a fraction of its peak. Infrastructure constraints and underinvestment limit short-term supply growth. Global oil markets have already discounted Venezuelan instability. In other words, you can't shock a market with risks it already expects. Key Cap 2. The US is energy resilient now compared to past decades. The US is one of the largest oil producers globally. Strategic petroleum reserve tools still exist. Shale production acts as a supply shock absorber. This reduces the geopolitical leverage Venezuela once had. Oil traders saw no immediate supply crunch, and that kept volatility muted. Key Cap 3. Liquidity is the real driver. Equities today are driven less by geopolitics and more by 1. Earnings growth. 2. AI productivity gains. 3. Interest rate expectations. 4. Liquidity conditions. As long as corporate earnings remain strong, financial conditions don't tighten suddenly, risk assets stay supported. This is why markets stayed calm. The bull case investors are seeing. Here's the key takeaway: upward trend. Markets interpreted this as noise, not a regime shift. The bull case rests on three pillars. Green circle: controlled energy prices. Oil stayed within a manageable trading range, avoiding inflation fears. That's bullish for consumer spending, transportation, industrials. Green circle: geopolitical fragmentation equals US advantage. Global instability often strengthens the US dollar, attracts capital into US equities, benefits American energy and defense firms. Counterintuitively, geopolitical tension can reinforce US market leadership. Green circle investors are trained to buy dips after years of crisis headlines. 1. COVID. 2. Wars. 3. Sanctions. 4. Rate hikes. Markets have learned, unless it hits earnings or liquidity, buy the dip. That mindset is still dominant. Which stocks were actually affected? Now let's talk winners and losers. High voltage energy stocks. Chevron, CVX, has direct exposure to Venezuelan heavy crude. Investors watched this closely. Stock reaction was muted, signaling confidence in diversified supply. ExxonMobil, XOM, benefited slightly from higher geopolitical risk premium. Strong upstream positioning cushioned volatility. Oil drum refiners. Companies reliant on heavy crude blends saw short-term uncertainty, but no structural damage. Factory defense and industrials. Lockheed Martin, LMT, Northrop Grumman, NOC, these stocks often see incremental interest during geopolitical escalations. Crossmark. What didn't move? Big tech. AI stocked financials. That tells us something important. Right finger. The market viewed this as isolated, not systemic. Bigger message from the market. Here's the real lesson. Pushpin markets fear inflation and liquidity shocks, not headlines. Unless Venezuela triggers a sustained oil spike, supply chain breakdowns, or financial contagion, US equities remain structurally bullish. The calm reaction wasn't complacency, it was confidence. If you want more breakdowns like this, where geopolitics meets market psychology, subscribe to Trendnomics, hit the like button, and drop a comment on which stock you're watching next.